Imagine this. You're scrolling through your bank account and you see a notification. $1,000 just hit your account from a gig you did last week. It feels good, right? That quick cash can pay the bills, fund a weekend getaway, or even treat yourself to something nice. But here's the question. Is that fleeting thrill of short-term cash the path to true wealth? Or is there something more powerful at play? Today, we're diving into the heart of this conflict. The temptation of quick cash versus the discipline of building lasting wealth. By the end of this video, you'll understand why long-term wealth is the ultimate game changer and how you can start building it today. The 2025 financial landscape. Let's set the stage with the financial reality of 2025. The average U.S. household savings rate is hovering around 4.5%, a significant drop from the 11.7% average in the 1960s and 1970s, according to the U.S. Bureau of Economic Analysis. This reflects a trend toward spending over saving, driven partly by the rise of the gig economy. Over 1/3 of the U.S. workforce is now engaged in gig work, freelancing, delivery gigs, surveys, and projections suggest this could reach 50% by 2025, contributing to a global gig economy valued at $646.77 billion. Meanwhile, inflation is at 2.4%, and the Federal Reserve's benchmark interest rate sits between 4.25% and 4.5%, with 2 rate cuts expected this year. These conditions make short-term cash appealing for immediate needs, but they also highlight the importance of long-term investing to combat inflation and build wealth. While gig income can cover today's bills, long-term strategies like investing in stocks, index funds, or real estate offer the potential for compounding growth and financial security. Let's take a quick dive into some key U.S. economic indicators as of 2025. First up, the U.S. household savings rate. According to the Federal Reserve economic data from May 2025, the savings rate stands at 4.5%. That's a modest figure, reflecting cautious optimism among consumers. Next, the gig economy workforce. Over 1/3 of the U.S. workforce is now part of the gig economy. And it's not slowing down. Projections suggest it could reach 50% in the near future. The gig economy market value. In 2025, it's estimated at a massive $646.77 billion. What about inflation? As of May 2025, the U.S. inflation rate is 2.4%, showing signs of stability after the recent economic turbulence. And finally, the federal funds rate. The current range is between 4.25% and 4.5%, as set by the Federal Reserve in June 2025, indicating a tight but controlled monetary policy environment. These numbers together paint a picture of a shifting American economy, one that's adapting rapidly, especially in the labor market and savings behavior. Defining short-term versus long-term strategies. So, what do we mean by short-term cash versus long-term wealth? Short-term cash strategies include freelancing, flipping items, delivery gigs, online surveys, and other side hustles. These are liquid, accessible, and perfect for immediate financial needs, like paying rent or covering an unexpected expense. However, they often come with income volatility, as earnings depend on market demand or personal availability. Long-term wealth building, on the other hand, involves investing in assets that grow over time. Stocks, index funds, real estate, digital assets, or even starting a business. These require patience but offer stability, scalability, and the power of compounding. For example, real estate can provide rental income and capital appreciation, while index funds can grow steadily with the market. The psychology behind the choices. Why do we gravitate toward one over the other? Short-term cash strategies tap into our desire for instant gratification. The thrill of a quick paycheck or the fear of missing out on the latest trend can drive us to prioritize immediate rewards. Lifestyle inflation, spending more as we earn more, keeps us trapped in a cycle of chasing the next gig. A study by Nobel Prize-winning psychologist Daniel Kahneman found that 90% of financial decisions are driven by emotion, with only 10% based on logic. Long-term wealth building, however, demands a different mindset. Delayed reward. It's about sacrificing today's wants for tomorrow's security, building a foundation for yourself and future generations. This discipline can feel daunting, but it's what separates those who survive from those who thrive. Data-backed comparison. Let's break it down with numbers. Imagine earning $1,000 a month from a gig. That's $12,000 a year. It's reliable cash flow, but it's volatile and doesn't scale easily. Now consider a $50,000 investment portfolio in the stock market with an average annual return of 7%. A realistic figure based on historical S&P 500 performance. After 20 years, that portfolio could grow to over $193,000, thanks to compounding. Short-term income is taxed as ordinary income, often at higher rates, while long-term capital gains enjoy lower tax rates, 0%, 15%, or 20%, depending on income. Short-term strategies offer quick cash but higher risk and volatility. Long-term investments provide scalability, lower risk over time, and the potential for passive income. When it comes to building income, two strategies stand out: short-term gigs versus long-term portfolio growth. Let's break them down. First, strategy. Short-term gigs are task-oriented. Think freelancing, deliveries, or contract work. In contrast, long-term portfolio building involves investing in stocks, real estate, or mutual funds that grow over time. Second, income volatility. Gig income is highly variable. One month might be great, the next, uncertain. Portfolio income, on the other hand, tends to be more stable over time, especially as it compounds. Third, time horizon. Gigs deliver returns in less than a year. Fast, but fleeting. Portfolios require patience, often 10 years or more, but reward you with compounding growth. Fourth, scalability. Gigs are limited by time and energy. You work more, you earn more, but only to a point. Portfolios can scale almost infinitely. With smart investing, your money works for you, even while you sleep. Fifth, risk level. Gigs carry high personal and financial risk. No work means no pay. Portfolios carry market risks, but with time, those risks can level out, especially with a diversified approach. And last one is tax implications. Gig income is usually taxed as ordinary income, often at the highest rates. Long-term investments may be taxed at a lower capital gains rate, ranging from 0 to 20% depending on your bracket. In the end, both strategies have their place. Gigs can help you survive. Portfolios, they help you thrive. Real-world examples. Real stories bring this to life. Take Ann Scheiber, who retired in 1944 with a modest income but built a $20 million fortune by investing in stocks and letting compounding work over 50 years. Her frugality and long-term focus turned small savings into generational wealth. Contrast this with many gig workers today. 44% rely on gigs as their primary income, yet struggle to save or invest due to income volatility and immediate expenses. Without a long-term plan, short-term cash can keep you afloat but rarely builds lasting wealth. Practical strategies for transitioning. How do you move from short-term cash to long-term wealth? Here are actionable steps. Save consistently. Set aside 10 to 15% of your income for investments, even if it's just $50 a month. Invest wisely. Use dollar-cost averaging to invest regularly in index funds or ETFs, reducing the impact of market volatility. Avoid traps. Steer clear of high-interest debt, lifestyle creep, and market timing. Pay off credit cards monthly to avoid interest rates averaging 20%. Build an emergency fund. Save 3 to 6 months of expenses to protect against unexpected costs, ensuring you don't dip into investments. Diversify. Spread investments across stocks, bonds, and real estate to mitigate risk. Future financial trends. Looking to 2025 and beyond, the financial landscape is evolving. AI-powered investing tools are streamlining portfolio management, with algorithms predicting cash flow and optimizing investments. Decentralized finance and fractional investing are making assets like real estate and stocks accessible to smaller investors. Financial literacy influencers and gamified saving platforms, like apps that reward saving, are making wealth building engaging. However, challenges loom. Inflation at 2.4% erodes purchasing power, cybersecurity threats cost financial institutions millions, and poor money management habits can derail progress. Staying informed and adaptable is key. Digital assets. Blogger, WordPress, Medium, Substack, Wix. Content creation can be a long-term digital asset. Here's a comparison of platforms in 2025. Blogger. Free and easy, but limited customization and monetization options. WordPress. Highly customizable, with plugins for ads, affiliate marketing, and e-commerce. Ideal for long-term wealth, but requires technical know-how. Medium. Great for exposure, but only 9% of writers earn over $100 a month, and you don't own your audience. Substack. Perfect for newsletters, with subscription-based monetization and direct audience ownership. And Wix. User-friendly with templates, but costly for advanced features. WordPress and Substack are best for long-term wealth, offering flexibility and audience control. A blog or newsletter could generate passive income through ads or subscriptions, potentially earning $500 to $5,000 per month with a loyal audience. Earning scenarios. Short-term versus long-term. Consider this. $1,000 per month from a gig equals $12,000 per year. Great for immediate needs but limited in growth. Now, a $50,000 portfolio at 7% annual return could grow to $193,483 in 20 years, providing passive income or a financial safety net. Short-term cash offers cash flow for survival. Long-term investments drive capital appreciation for thriving. The choice depends on your goals, but combining both, using gig income to fund investments, can create a powerful financial strategy. So, how do you view money? Is it just a means to pay the bills, or a tool to build a future you can believe in? If you're ready to shift from short-term cash to long-term wealth, start small. Save consistently, invest wisely, and let time do the heavy lifting. Subscribe now, and let's build a future together. One where wealth isn't just earned, but built step by step over time. Remember, true wealth isn't about the quick win. It's about the long game. Start today and watch your future transform. See you in the next video.